Good morning and welcome to the March 2024 meeting of the SEC's Investor Advisory Committee. My name is Christopher Mirabile and I serve as the chair of the IAC. Before we get started, I'd like to hand it over to Danielle to do a quick roll call. We are mostly in person today, but we do have at least one person participating by video conference.
Thank you, Christopher. Jamila Abston Mayfield.
Present.
Cambria Allen Ratzlaff.
Present.
James Andrus.
Present.
Chen Asuera.
Present.
Ted Daniels.
Present.
Gina Gale Fletcher.
Present.
Alyssa Germain.
Present.
Brian Helmer.
Present.
Colleen Honigsberg.
Present.
Christine Lazaro.
Present.
Nancy Lamond.
Present.
Lori Lucas.
Present.
Christina Martin Fervita.
Present.
Christopher Mirabile.
Present.
Andrew Park.
Present.
Sandy Peters. Nothing heard. Sandy will be joining at around 11:30. Dr. David Royney.
Present.
Paul Roy.
Present.
Brian Shore.
Present.
Paul Summerstadt.
Present.
Alice Steinbaugh.
Present.
Leslie Van Buskirk.
Present.
Joanne Yu.
Present.
Thank you. Back to Christopher.
Thank you, Danielle. We have a substantive agenda today, a couple interesting panels, and we'll also be discussing a recommendation. Our morning panel will begin shortly, and it will be moderated by Gina Gale Fletcher, who is a professor of law at Duke University School of Law and vice chair of the Investor Advisory Committee's Market Structure Subcommittee. Andrew Park will also be co-moderating, and Andrew is a senior policy analyst focused on hedge funds and private equity at the Americans for Financial Reform and serves as the chair of our Market Structure Subcommittee. The panel will discuss the SEC's 2022 proposals to improve equity market structure. The SEC in 2022 proposed a number of rules with the aim of improving the transparency and fairness of trading in the equity markets. Panelists will discuss aspects including a novel auction system in lieu of payment for order flow, and will discuss overall how the proposal may impact best execution. Then we will break for an administrative session from 12:05 to 1:35, followed by an afternoon panel examining the use of materiality as a disclosure standard, asking whether the definition can be improved to better serve investors. This session, which will be moderated by James Andrus, who is Vice President of Sustainability and Global Markets at Franklin Templeton and serves as the chair of the Investor Advisory Committee's Investor as Owner Subcommittee. The focus of the panel will be to acknowledge that 2024 marks the 25th anniversary of Staff Accounting Bulletin 99 on materiality, and ask whether this is an appropriate time to reflect on its impact and legacy, as well as to discuss current challenges with the use of the materiality concept. Ultimately, the panel will be asking, are there ways for the SEC to improve disclosure decisions to better serve investors trying to evaluate both risk and return opportunities? As I said, following the afternoon panel, the members of the Investor Advisory Committee will hold a discussion regarding a possible recommendation on digital engagement practices. Before I hand it over to the commissioners to make their opening remarks, I'd just like to briefly say that this is my final quarterly meeting as both a member and a chair of the IAC. I would like to thank the chair and the commissioners for the opportunity to serve on the IAC. And I would like to thank the investor advocate, Christina Martin Fervita, and her tireless staff in the Office of the Investor Advocate for all the myriad ways they support this advisory committee. The members of the IAC care deeply about the mission of protecting investors and are profoundly motivated to participate in IAC activities, but they are volunteers who also hold day jobs. We could not do what we do without very substantial assistance and support from the Office of the Investor Advocate. Thank you for your assistance and for allowing me and the members of the IAC to go to bat for investors. Last but not least, I would like to express my appreciation for my fellow IAC members. Your dedication, commitment, and professionalism, even in the face of my attempts at humor, is an inspiration to me and has made my time on the IAC a wonderful and rewarding experience. I will miss working with all of you and all of the staff when my term ends in May. Now I will turn to opening remarks from the Chair and Commissioners. Chair Gensler.
Well, good morning, and I'm pleased to speak to the IAC. I think this is working. As is customary, I'd like to say that my views are my own as Chair of the Securities and Exchange Commission, and I am not speaking on behalf of my fellow commissioners. You'll hear from Commissioner Peirce. I think Commissioner Crenshaw, I see, is online, and they'll express their own views, and I'm not speaking for the staff. Well, Hester, unless you want to agree with everything. Not? No, okay. Just seeing we can get there. Look, I want to start by thanking, there's 5 of you that this is either your last meeting or your terms are near up, expiring in May. Christopher, of course, who's been serving as chair, Chian, Ted, Elisa, and Lori. So thank you all. I know that it's volunteer work, but we, the commission, really do benefit from getting your advice and counsel. I understand that you're talking about 3 things today. You've got an esteemed panel. I guess Gina Gale is going to lead this panel or moderate a panel to discuss equity market structure. And then you're going to be talking about, James, you're doing the definition of materiality and then recommendations with regard to digital engagement practices. First, as it relates to equity markets, we finalized a rule already shortening the settlement cycle. Some forget that, but that's a really important rule. I would note, 9 years ago, this committee, the Investment Advisors Committee in 2015, when the settlement cycle was 3 days, recommended shortening the settlement cycle to 1 day. So here we are 9 years later. We've already, of course, shortened it to 2 days back in 2017, but I want to thank the IAC for that recommendation. And I'm happy to say that in a few months after Memorial Day weekend, we will achieve that goal. Time is money. Time is risk. This matters to everyday investors who now, if they sell their stock, well, after Memorial Day, but if you sell your stock on a Monday, you'll get your cash on a Tuesday. And it lowers the risk in the system as well. Second, just yesterday, we updated a 24-year-old rule. It's called 605. But it's on the disclosure of order execution quality. It will improve transparency for execution quality and really facilitate investors' ability to really compare brokers. And you can see the difference of the quality of brokers, thereby enhancing competition in our markets. But there are some things that we've proposed and not yet adopted, and we will benefit from this discussion today. We've gotten thousands of comments on each of these proposals, but the staff is still considering what recommendations to the commission. So what are those for? We have a proposal updating key features of what's called the national market system, and this includes minimum pricing increments for quoting and trading, access fees, round lot orders, and the like, trying to help level the playing field. We live right now in a market where about 1/3 to 50% of the market is off exchange, what is colloquially called the dark markets. And if you're actually trading your everyday investor and you put a market order into the system, it's well over 90% of retail trades don't go to a lit exchange. They go off exchange to wholesalers. And so we're trying to address and bring greater competition there. Another of the proposals the Commission proposed is for the Commission to adopt a best execution standard. Now, there is a standard at the self-regulatory organization, FINRA. I was struck when I got to this agency when I said, could I see a copy of the SEC's Best Ex rule? I'd been around markets for a long time, but I didn't actually understand it's not the Commission's. In essence, that a broker-dealer seek the best execution for customers when they buy or sell securities. Seems pretty straightforward. I, for one, supported the proposal, and I'm looking forward to the staff's recommendations on how to really finalize this. It goes beyond the stock market, though. It covers all securities markets, including equities, fixed income, and yes, crypto asset securities, if you just had any questions about that. Another proposal we put out is a proposal to bring greater competition for a segment of the market related to individual investors' marketable orders. I think Christopher mentioned it. And we also, more recently, actually on my birthday last year, put out a proposal regarding exchange volume-based rebates and fees. So it's going to be terrific to get your feedback. Your second topic, the 25th anniversary of the so-called Staff Accounting Bulletin 99. I know James is going to lead this discussion about materiality. Well, our federal securities laws lay out a basic bargain. Investors get to decide which risks they take, so long as companies raising money from them make what President Roosevelt called complete, truthful, and disclosure. Complete and truthful disclosure. At the SEC, as I said at my confirmation hearing, I was asked about this 3 years ago this month. I'm guided by materiality as it relates to disclosure requirements under the federal securities law. And just yesterday, the Commission adopted final rules to mandate climate risk disclosures by public companies and public offerings. And consistent with this agency's disclosure rules over the decades, these final rules are grounded in materiality. Materiality represents a fundamental building block of disclosure requirements under the securities laws. The Supreme Court articulated the meaning of materiality in multiple cases in the 70s and in the 80s. This SAB 99 came along in the 1990s. It's a standard of materiality that's reflected in Commission rules. It's the same materiality standard that appears in numerous of our rules. It's the same materiality standard that we used yesterday in the final rule around climate disclosure. I would note also that materiality has been incorporated in many international disclosure regimes. We look to U.S. law, but it's also a standard in international. For instance, it's been integrated throughout the International Sustainability Standards Board's recently adopted, last June of 23, sustainability and, yes, climate-related disclosures. And in the ISSB release from last June, this applies as well to required greenhouse gas emissions disclosures under their standards, materiality. Finally, you'll be considering recommendations on digital engagement practices. In finance, predictive data analytics has potential benefits of greater financial inclusion, enhanced user experience. I think it's the transformative technology of our time. It already has been fueling rapid changes in the field of robo-advisors and brokerage apps. AI also, though, can raise issues if the optimization function, the little math that goes with it, if that optimization function in the AI system is taking the interest of the platform into consideration as well as the interest of the customer, this can lead to conflicts. And in finance, when brokers or advisors act on those conflicts and optimize to place their interest ahead of their investors' interest, whether it's a brokerage app or an investment app, then investors may suffer financial harm. That's why the SEC proposed a rule last year regarding how best to address such potential conflicts. This committee's advice will go into our record. I'm sure, Christopher, now you'll hand it over to other commissioners that will speak for their own, but if Hester wants to agree with some of the things I talked about, it would be fine.
Thank you for those remarks, and I do want to reassure Commissioner Peirce that she's welcome to agree or disagree. So over to you, Commissioner Peirce.
Thank you, Christopher, and good morning to all of the committee members and also the panelists who are here with us today. It is wonderful to see everyone in person. So as you've heard, it's the last meeting for Christopher, who's been a great leader of this committee, and also for Chen, Ted, Alyssa, and Lori. Thank you all for your contributions. I think as you've realized, being selected as a member of the IAC is an honor, but it also comes at a great cost in terms of time and energy, and you all have really dedicated a lot of time and energy to the work, and I appreciate it. I will say that I can agree with something that Chair Gensler said, which is we both voted yesterday to support Rule 605 amendments, and I think both of us saw that as being sort of a good building block for anything else that might be done on equity market structure. Now, that may be where the agreement ends, but we'll see. I think each of the remaining equity market structure rules does raise significant questions, including in connection with some of them, what are we actually trying to solve? And so I think once we get that information under Rule 605, under amended Rule 605, it will help us to assess whether there is a problem, and if so, what the solution should be. I think that all of you this morning will help us assess those questions as well, so thank you for being here. The second panel on materiality, I have to say, you have to love any group that marks the 25th anniversary of SAB 99. That's a rare thing. But actually, I think it's you all planned very well, because your first panel ties to the 605 rule that we did yesterday, and then the materiality panel ties to the climate rule. I did not support the climate rule, and in part because I think it actually is not rooted in materiality. It does say the word materiality a lot, but I would argue that it is a departure. I don't say that climate-related information can't be material, but I would say that can already be captured under the current framework. Our rule presumes that a highly detailed set of climate disclosures is material across all companies. Information is material if there's a substantial likelihood that an objectively reasonable investor would consider the information important to an investment or voting decision. All reasonable investors value financial returns, but they may diverge on which non-economic considerations, if any, are important to them. A regime rooted in materiality, I think, looks to meet the economic information needs of investors, and it helps companies then inform investors without serving them up a blizzard of immaterial information, which costs them money to produce. It costs the company money and hence the shareholders money to produce. I think if we move away from materiality, as I think we did yesterday, we could end up with, as I said yesterday, a hodgepodge of requirements tailored to meet the demands of a vast and ever-expanding panoply of special interests. What is the limiting principle? So I hope that's something that you all will talk about today. And then specific to the climate rule, but I think illustrative of redefining materiality, I'm curious to hear what the panelists and the committee members think a materiality determination would look like with respect to greenhouse gas emissions. Yesterday's rule requires disclosure of scopes 1 and 2 greenhouse gas emissions, but only if they're material. So I'd love to hear how you think about materiality in that context. And then the committee will consider a draft recommendation concerning the predictive data analytics proposal. As you heard, and this draft that you're all looking at today supersedes the draft recommendation that was introduced at the last meeting. It was not voted on then. So I am interested in hearing today's discussion on the recommendation, but I would have liked to see, and poor Christopher, this is your last time that you have to listen to me complain about a process issue. But I would like to see more time allotted to discussion of recommendations. The discussion of the draft at the last meeting, I thought came across as extremely rushed. It sounds like there had been other conversations that had occurred around that draft recommendation, including committee members and maybe non-committee members as well. And then it seems that based on those conversations that happened outside the context of the meeting, a decision was made to pull that recommendation and rewrite it. So I would have liked to hear more about why that decision was made, particularly because the draft that you all are looking at today is quite different from the one that you were looking at last time. So I'd like to understand what the rationale for those changes is, and hear committee members' thoughts on the draft recommendation. What, for instance, explains the notable departure from the last draft's emphasis on the often curative role disclosure plays when a conflict is present, and the concerns that the proposed rule could upend that? Why is today's draft so toned down? Again, the half hour allotted to that discussion will make it impossible to get a full view into why the draft changed and what committee members think of a rule that actually has drawn quite a bit of comment. Much of it is not particularly positive, so it would be very helpful for me to understand what this committee thinks of it, and so taking a little extra time to discuss a recommendation like this, I think, and most recommendations, I think, deserve a lot of robust discussion. Committee members have different views on things. That said, I don't want to cut short the panel discussions, which I think will be fascinating. I'm very much looking forward to those. I want to thank you all again for your willingness to serve, and thanks to Christina and Tony and others and Mark Sharma, others on your staff for your work in making this committee and its meetings happen. Thank you.
Thank you, Commissioner Peirce. If 24,000 comments is quite a lot, I wonder what.
Well, 24,000 on the climate rule. I don't know
Yeah,
how many we've
yeah.
gotten on the digital engagement practices. Fewer, but a lot.
I don't know, but we'll continue to review those, and the comments today will be part of the record as well.
Good stuff. Thank you very much. Commissioner Crenshaw, are you on the line?
Yes, good morning. It is, as always, a pleasure to be here with you this morning, even if virtually. You've chosen a busy week to have a meeting. I'm not sure if you noticed, we approved a little-known rule yesterday. Some of my colleagues might have mentioned it. It's the best-kept secret in Washington. Outside the building, we have Super Tuesday this week, the State of the Union tonight. Certainly a very busy week. The press and those political junkies in the room will have lots to talk about in addition to the substance today. I will start with some hellos and some goodbyes. As we head into spring, it is turnover season in some of our committees, including this one. And I do also just want to give a heartfelt thank you, starting with some of the officers who will be or already have rolled off of their officer positions. First, Leslie Van Buskirk, who previously served as the vice chair of the committee, a more tireless and selfless advocate I could not dream up. Leslie has committed her life's work to pursuit of investor protection as administrator of the Division of Securities at the Wisconsin Department of Financial Institutions, and now president-elect of NASA. So Leslie, thank you for your service as vice chair of the committee and for playing a leadership role on so many important projects on behalf of the committee and investors, including work on Regulation D and private markets, which has been both informative and compelling. Ted Daniels, his term as security as secretary, let's try that again. Securities law secretary, different words. As secretary, also is expired in December. Ted, you've served this committee for nearly 4 years, and we are so very grateful to you for your commitment and your service. And of course, Chris, whose term is coming to a close in May. I thank you for your leadership and your service. You've been in this role, and it's a very time-consuming and demanding role, and we appreciate your dedication and all of the time you've put into this, and we wish you all the best of luck in your future endeavors. To the new officers who will serve on the committee, you have an influential podium. Use it with judgment and discretion, and with the unwavering goal of helping investors, particularly retail, who are all too often unheard. And then just lastly, to the others, I probably should have reordered that. But the others, Chen and Alyssa and Lori, rolling off the committee, coming up here too before our next meeting. Wholeheartedly thank you for your service. As Commissioner Peirce said, it's an honor, but it also is a lot of time and potentially a lot of thankless hours. So we really appreciate that. So today you have another jam-packed day. First, we'll hear from an esteemed panel on equity market structure proposals. I look forward to the panel giving us informed views and useful data to help us determine if our proposals will, in fact, make equity markets more fair and transparent, which I think is, to me, clearly the goal of the proposals. Then in the afternoon, we'll hear from another distinguished panel on materiality, on the materiality standard. As someone referred to it yesterday, a bedrock principle of securities laws. But this is the 25th anniversary of SAB 99. And so just from what I was hearing this morning, I urge you, SAB 99 is particular to materiality in financials and audits of those financial statements. So I just want to make sure that we're clear in our discussion, sort of what exactly we're talking about when we're talking about SAB 99. And make that very clear for not just those in the room, but the investors watching, and for the advice that we're thinking through for investors. Sort of what is the world that we're actually talking about when we're talking about SAB 99. As part of that panel, we'll hear from Lynn Turner, one of the authors of that bulletin, as well as a number of highly acclaimed academics and practitioners. And so looking forward to hearing their views on how well that has aged. Thank you all again for your time, for your commitment. I'm looking forward to today's insights and looking forward to continuing work of the committee as it moves forward. Thank you all.
Thank you again, Chair Gensler and Commissioners Peirce and Crenshaw. We appreciate your opening remarks and your ongoing dialogue with us. Next on our agenda is approval of our December minutes, which have been circulated prior to this meeting. Do I have a motion to approve the minutes?
So moved, Christopher.
Thank you. All those in favor?
Aye.
Aye. Aye.
Aye.
Any opposed? Terrific. The minutes are approved. Next up, as I said, is our morning panel on market structures, and I would like to hand it over to Gina Gale and Andrew, if I could, please.
Thank you. Thank you, Christopher. Please let me know if this isn't working. Good morning, everyone. My name is Gina Gale Fletcher. I'm a professor of law at Duke University School of Law, and I'm here to lead this morning's discussion on equity market structure reform, the proposals that the SEC has put forward. So equity market structure is not exactly a topic that gets us all ready and rearing to go, but it is one that has a significant impact on each and every investor within the marketplace, from the smallest retail investor to the largest institutional investor, and really everyone in between. Much of the current equity market framework that we have today was implemented through the adoption of Regulation NMS, Regulation National Market System, in 2005. And Reg NMS sought to enhance transparency by improving the display of quotes and access to market data, and basically ensure that investors get the best price on their orders. Since the adoption of Reg NMS, the SEC has adopted some reforms, making changes on the margins as to how equity securities are traded, but by and large, there have not been significant updates to equity market structure regulation in the almost 2 decades since the adoption of Reg NMS. And this is despite the very significant changes that we have witnessed in the marketplace as to how trading occurs over the years. Indeed, we've gone from people using hand signals on the floor to people now using laser beams to trade in fractions of a second. The fact that regulations have not kept abreast with these market changes have raised concerns among varying market participants about the market's transparency and its function. And some common complaints that are often raised today include the fact that, or the thought that the markets are too fragmented, too complex, with well over a dozen exchanges, many of which have similar fees and products, and as well as dozens of dark pools and even more internalizers. We have complaints about transaction fees, which were set almost 2 decades ago by the SEC at 30 cents per 100 shares traded, and thoughts that these transaction fees are indeed too high. We have complaints that investors, both institutional and retail, are simply overpaying their brokers or are disintermediated and are getting worse prices than they should. And then we also have complaints that the current rebate practices and routing incentives lead to certain market distortions, inhibit competition and consolidation, and lead to direct investor losses on execution prices and a lack of investor choice, among other concerns. Mindful of these and other issues, the SEC proposed 5 substantive rules, as Chair Gensler mentioned earlier this morning, which, if adopted, would represent the most significant changes to U.S. equity market structure since Reg NMS. Today, we are discussing 4 of these. Sadly, the one that was adopted on Chair Gensler's birthday is going to be outside the scope of our discussion for this morning. And so today, the 4 that we are going to be discussing include amendments to Rule 605, which, as the Commissioner Peirce and Chair Gensler mentioned, were adopted unanimously yesterday. And so we're going to consider what the impact of these updates will be and think about whether we have any other suggestions for how these would move forward. We're also going to consider the proposed amendments to Regulation NMS, which would cover tick sizes, transaction fee caps, rebate transparency, and the reporting of odd lots, among other things. Next, we're going to think about or talk about the order competition rule or the auction rule, which would generally require smaller dollar orders to be displayed to the broader public markets in an auction style prior to execution. And we will wrap up our discussion with the SEC's proposed Regulation Best Execution, which would establish a new SEC-specific best execution rule, which, as I hope we'll be able to talk about in our discussion, varies or differs from the FINRA's existing rules and guidance. So joining us this morning to discuss these proposed and the adopted rule that was adopted yesterday in the U.S. equity market structure are 5 distinguished panelists. First, we have Mehmet Kanak. Mehmet is a vice president of T. Rowe Price Group. He is the global head of equity trading, and his responsibilities include overseeing T. Rowe Price's trading desks globally and leading efforts to improve the overall trading process. Next, we have Anna Kurzrock. Anna is a managing director at Jefferies and holds the role of head of market structure. Prior to joining the firm, she held similar positions at BNP Paribas and Deutsche Bank and at RBC Capital Markets, where she was also responsible for U.S. and European electronic sales. We also have joining us Dave Lauer, who is the CEO of Irvin Finance and the co-founder of We the Investors. We the Investors is a grassroots advocacy campaign helping to empower individual investors to change market regulation. Also with us is John Ramsey. John is the Chief Market Policy Officer at IEX Exchange. At IEX, John is responsible for developing and communicating IEX's positions on market policy issues, engaging with governmental and regulatory organizations or authorities, and liaising with pension owners and other asset owners. John joined IEX in 2014 from the SEC, where he led the Division of Trading and Markets. So I guess this is welcome back, John. And we also are joined by Professor Chester Spatt. Professor Spatt is the Pamela R. and Kenneth B. Dunn Professor of Finance at the Tepper School of Business at Carnegie Mellon University, where he has taught since 1979. He has also served the SEC, and he served as the chief economist for the SEC between 2004 and 2007. Professor Spatt is a well-known scholar studying financial economics with broad interests in the financial markets. So welcome back as well, Professor Spatt. Now, one thing I did want to note before we got started with our panel this morning is that we're going to take a slightly different format, meaning instead of our distinguished panelists giving us their wonderfully done PowerPoint presentations, because I have no doubt that they would be nothing short of amazing, what we are going to do instead is have a moderated discussion. So I will be proposing or asking questions to our panelists, and our panelists will have what I hope to be a somewhat organic discussion about the different proposals, and I will be kind of feeding us questions, piggybacking on those, and our panelists will be providing us with their thoughts and opinions on the different proposals. And so just to reiterate the order that we're going to go in, we're going to talk about the adopted Rule 605 first, then do Reg NMS with the ticks, the fees, the rebates, all the good stuff. I know a lot of you are chomping at that bit. We're going to talk about the auction proposal, and then we're going to wrap it up with regulation best execution. Okay, so to start us off, Rule 605. So Rule 605 was recently adopted yesterday and updated by the agency, and it was unanimously approved by the commissioners. For those who aren't familiar, Rule 605 requires exchanges and alternative trading systems, ATSs, to provide specific execution quality statistics, including effective spread, average amount of price improvement, and number of shares executed, as well as the speed of execution. In December 2022, all five commissioners supported proposing reforms to Rule 605, and those proposals or those reforms were adopted yesterday. Among other things, the final rules updating Rule 605 do a few things. First, it expands who files the reports to include large retail brokers that have more than 100,000 customer accounts. It requires brokers that operate alternative trading systems to separately file different 605 reports for their broker-dealer activity, separate from their market center activity. It adopts a new size order reporting increments for orders up to $250. It revises timestamp conventions, and in a change from the proposal, it has order execution time buckets with greatly reduced time periods. And so now we have 8 time buckets that range from 100 microseconds to 5 minutes or more. But unlike the proposed rule, the final rule does not require that Rule 605 reports be filed in a centralized database. And this is a very high-level overview of 605. So, Dave, if I may, Dave, I wanted to start with you. I know that you have felt strongly about Rule 605 over the years. And so why have you so vigorously argued to expand the scope of covered orders? And why are these time buckets that we now have in the final rule important?
Yes, thank you, Gina, Gail, and Andrew for putting this panel together, and thank you for inviting me to participate. I think markets are here to serve investors and issuers, and all too often their voices are drowned out, so I think it's really important to have these kinds of conversations at this level. Disclosure is a critical component of our market structure, and as the chair mentioned, these rules around disclosure, 605, and before it was updated 606. 606 was over 20 years old. 605, almost 25 years old. And I don't know if you've noticed, but markets have changed a little since then. And it's been time to update these rules for over a decade. And yet, not to look a gift horse in the mouth, it's excellent that they have finally done this and taken these steps. Transparency can often simply by itself lead to changes in behavior. When the original 605 and 606 rules were passed in 2000, adopted in 2001, they led to distinct behavioral changes because now there was visibility into how brokers were routing orders and how market centers were executing those orders. So transparency is a critical foundation for market structure, especially a complicated, fragmented market structure like we have in the U.S. To give you a sense, the Rule 605 that is still in effect today says, how long does it take to execute this type of order? And the first bucket is 0 to 9 seconds. That's an eternity in markets, and it doesn't give any information anymore by saying, we're a market that executes orders between 0 and 9 seconds. So we have been pushing, and I've been pushing for, like I said, over a decade to rationalize this type of disclosure with the reality of modern markets and electronic markets. So the rule that was adopted expands these execution quality disclosures to all sorts of new order types and order sizes that it didn't include before. So fractional orders, odd lot orders, orders outside of regular trading hours, and it breaks apart all of these new order types so we can finally get some visibility into how different market centers are executing these order types and how brokers are accessing those market centers and performing primarily for their retail investors. So that in itself is another really significant step forward. It's really helpful for smaller firms, especially, who don't have the resources to devote to quantitative analysis of broker order routing algorithms, which is something I've spent quite a bit of time doing. And it also brings SDPs, single dealer platforms, into and separates them out so that now we can see, again, these areas of the dark markets, as the chair talked about, in which so much order execution is taking place. We can actually disentangle those things and get visibility into how firms are handling orders. So I just think it's a huge step forward, and it's sort of the step one when you're looking at how we approach holistic market reform.
Thank you, Dave. So Anna and Mitt, I'm going to ask you this question, and you guys can decide amongst yourselves who gets to go first. But when Rule 605 reports were first adopted, brokers used them a fair bit. But I've heard that they don't use them as much anymore under our current Rule 605. Obviously, the one just got adopted yesterday. So as someone who spends a fair bit of time analyzing market structure, where do you think the new Rule 605 rules will be most impactful? How do you think it's going to really change how these reports are being used? Do you think your firms will be using them more? Will it be retail who'll be using them more? Dave kind of opined on this a little bit. Kind of want to flesh that out a little bit more. How useful do we now think these reports will be, and who do we think will be using them?
I'll go first. Thank you for the opportunity to be here. Good morning, everyone. I think initially, first I want to commend the Commission for adopting these. I think the Transparency Initiative and the additional information will be useful to what I hope will be all investors, quite frankly. But I think, the most direct impact, the way that it was designed, I expect would be most useful to retail investors, simply because they don't have that visibility, as Mr. Lauer explained. We on the other hand, as broker dealers and institutions, with our business model, we have, other data and other robust data that we use on our day-to-day basis. Having said that, I think what these updated reports do, I know personally, I will be very curious to see what these reports look like in practice, because they take into account so many other pieces of the markets that have evolved since this rule was initially adopted back in 2005. So I think it will, at the very least, give me personally a good baseline to see, okay, what does today's market actually look like in this framework, and perhaps use it, maybe not in the manner that a retail or individual investor might, or another broker or another participant, quite frankly, but sort of to see how the market evolves and how this report will look like, as it evolves too.
Yep.
Good morning.
Good morning.
Let me start out by saying, first of all, for those that may not know, I used to be in this room regularly, serving as a member of the Equity Market Structure Advisory Committee. So it's very familiar to be in here. It's great to be back. I think it's imperative that the SEC do more of these types of engagements with the industry. We used to do them much more regularly. I was also across the hall at one point in 2018 doing the Market Data Roundtable. And I thought those engagements really gave the industry the opportunity to kind of voice concerns in areas that the SEC should be looking at. And I feel like, unfortunately, we don't have enough of those engagements. So I thank the IAC for doing this and hosting this meeting and allowing me to participate. Not a lot has changed, although I do see Zoom now from being in this room. We didn't have that back when I was serving at MSAC. And my eyes aren't as good as they used to be. So when I look down at the paper, apologies if I start messing with my glasses. As far as T-Rowe, I'll just give you a general sense. I know Gina Gale introduced me as being head of global trading at T. Rowe Price. I want to make sure everyone recognizes, if you're not familiar with T. Rowe Price, what we do. We manage, we're a global investment manager that manages about $1.4 trillion in assets under management. We serve both individual investors as well as large institutions. I want to be very precise in saying that. We serve individual investors. I think it's important to note, a lot of times there's, people view retail to be different than the individual investors that invest in firms like T. Rowe Price. They are one and the same. And statistically, if you actually look at the numbers, they have more money actually invested in their retirements and pension plans than they do in the stock market individually. So it's important that when we're crafting rules and proposals that we do it so that when people say we're trying to help retail, we want to make sure we're also not harming them in their institutional wallets as well, so to speak. As far as what T. Rowe does, we do not act as a market maker. We do not act as a venue, a trading venue, and we do not generate any revenue or compensation from any of the trading activity that takes place in our portfolios and funds. I want to make that very clear. Now, 605. It was great to see that get passed. I think it was, of the 4 proposals, I think it was the least controversial. I think everyone probably is aware of that. And we're all in favor of transparency and disclosure, and we're supportive of any kind of information. You know, I'm very good with data. To kind of give you more context, I love technology. I stink at PowerPoint, Gina Gale, so thank you for not making us have to do a PowerPoint presentation this morning. But I think it is important to have transparency. Now, what I would say is Dave Lauer made a comment around the fact that behavioral changes take place when transparency is promoted into the market. So as we go into these 4 proposals, and I look at them as one package, I do not look at them individually. So I think that's important to denote as well. We have to be very careful to recognize that 605 changes taking place will have potential impacts to other behavior and potentially other proposals. So I think Commissioner Peirce said this yesterday. It's important that we take that incremental approach to implementing certain things and then measuring whether or not they have an impact in our markets and whether or not they achieve what they are intended to achieve. So when she says, what are we trying to solve for? If we're trying to solve that the individual retail investor has a better experience, again, I'm all for that. Very happy to have that come to fruition. We have to make sure that we can measure it, and that if it is measurable, that we have concrete evidence that it's working better. I think 605 does that. I think you saw the unanimous vote yesterday. I think the SEC recognizes that we need better measurables around whether or not retail has a better engagement. But it's important then not to tinker with other aspects of it, because from a data perspective, it's very hard to measure when you make a lot of changes to how the market operates. So very happy that 605 is in. I don't know that we would use it, Gina Gale. To be honest, we have, as Anna mentioned, we have a lot of other data points that we look at, from whether it's the brokers supplying us with information, our own information. We have our own in-house analytics team that evaluates everything from execution quality onto everything that we do from our trading desk. So it's more for that individual investor. Now, I will say in my 24 years at T. Rowe Price, I've never once heard of a retail investor looking up 605 stats, or 606 stats for that matter. So I don't know how heavily it will be used by an individual investor, but it does give individuals like Anna, myself, Chester, and others the opportunity to kind of look into more granular information and be able to analyze and get some interesting tertiary, probably, data points for us.
All right. So actually building a little bit on Mett's last point about people not really making use of the report, of the 605 reports. One of the things that the 605 rule proposed was that the reports would be centralized. And in the final rule, that got done away with, and so it is not centralized. And so, John, I wanted to ask you if you would be so kind to opine on, well, how do you think this might impact the usefulness of these reports, or, the usability of them, just generally, if they're not centralized, but you have to kind of go hunting and pecking across different actors to find these reports?
Yeah. Thank you for the question. Again, appreciate being back here. It's a little bit of an out-of-body experience being back in this room, but I do appreciate it. The answer to your question, from my perspective, although at a superficial level, it's kind of nice to have reports all aggregated in one place, I don't know that it will have a huge impact on people's ability to use it, which is just to say, kind of to Matt's earlier point, even with the updated data, I doubt that there are a lot of individual investors themselves that are going to, rush to the website to pull all of these comparative. So I expect, as is currently the case, this will be largely intermediated, and individual advisors or brokers will be able to cull the data that they need from these various sources, and then provide it in forms that are most useful for their particular customers. The most important part of the change, I think, was to create a subset of the data that is intended to be provided in kind of individual investor user-friendly form, so that individual investors that really do want to just see the highlights, that there is that's available. So I would say that about that. I would push back a bit on Matt's point about 605 sort of as a predicate for moving forward on any other aspects of market structure reform. And so I think it's important to understand that the purpose, again, of the 605 reports was to provide comparative data for investors to be able to look at how different markets are performing based on the rule set that exists at any one particular point in time. So 605 was never intended, I think, to provide a primary data source that would then drive determinations of what other market changes might be necessary. So I would say, in particular, for changes like updating the tick size or updating access fees and talking about minimum trading increments, those kinds of things that people literally have been talking about and arguing there need to be updates for the last 20 years. It seems to me there is no reason why we need to wait for whatever 605 reports might glean about how investors, the reports based on the existing rule set and how it is those change. So I think, Matt, I think certainly is not doing this. I think folks that make that argument in some cases are doing it as a form of a sort of dodge to avoid sort of kick the can down the road as far as possible because they would prefer to avoid more changes to the rules.
Thank you, John.
Can I just, sorry, I just want to interject really quick.
Okay.
The question of will retail investors use these reports and are they using these reports? I think people might be a little surprised at the sophistication, the level of sophistication of many retail investors today. I often see 606 reports being discussed online. I see people making charts, tracking that data, and providing analyses of how brokers are routing orders, and even using that information to change who they do business with. And I think the 605 reports have not been used because they've been in a terrible format to be used. They haven't contained much modern information, and I do think that these updates will lead to a couple of things. It will lead to retail brokers having to publish summary reports, which is absolutely one of the most important parts of it, but it will lead to other sites, as John is saying, that bring that data together, visualize it, help people understand markets and how markets are executing orders. I would have liked to see the SEC do that. And put up a really nice, analytics and data visualization site, and that's okay that it didn't happen because others will step in. But, I think it's important to understand that there are large numbers of retail investors that do care about this information and would use it if it was in a more usable form.
Okay, thank you. Professor Spatt, I'll ask you our final question here on 605. And really, it's kind of a global question. So do you think, that's kind of been a debate here, do you think this Rule 605 is, what are your thoughts on it overall, right? Do you think it's a good first step? Do you think it's gone far enough? What would you say in terms of how the finalized Rule 605 looks?
Well, excuse me. Yeah. Well, first, I should say I very much appreciate the opportunity to participate in the panel. Like Mehmet, I was a member of the Commission's Equity Market Structure Advisory Committee from 2015 to 18, and like John, I'm a former member like John, and in my era, Paul, I'm a former member of the staff. I was chief economist from 2004 to 2007, and it's very good to be to be back. I think like the unanimity on the commission and also the comments of my fellow panelists, I think the adoption of 605 yesterday was a good thing. I think this will result in improved disclosure. Now, whether the disclosure is used by individual retail investors or it's used more by intermediaries, I think this is more of an open issue. But I think that's a very good development, and I think there's a lot to be learned from that, from more informative disclosures. Indeed, I think motivated by some of these issues, my collaborators and I reached out to some retail brokers a year or so ago, and we persuaded three of them with a market share of about 50% of the retail space to provide us data about their order routing, and we wrote an academic paper on that basis. We filed that with the commission as part of our comment letter at the end of November, and I also filed it with the committee last week. And that's sort of I think my main takeaway from that is that brokers do recognize that part of what they need to do is to focus on holding the feet to the fire of the wholesalers, and what they do is they reroute based upon relative performance, and I think the data on that is striking. They reroute based upon price improvement or effective over quota. This is sort of part of this is part of the business model, and I think sort of seeing that data was very informative. And I think the extent to which that type of data becomes more widely available through the 605 process, I think that'll be very useful in terms of educating the extent to which execution quality seems to be pretty good. Now, I should say that our data was in the data we obtained was in the equity space, and so there may be issues and options in other kinds of spaces due to other kind of market structure issues that the commission, unfortunately, is not taking on currently. And one final point that I should note. I think to some degree the inferences that can be obtained from some of the order routing isn't necessarily what people think. I think a lot of people think, oh, this data will show one broker is doing a better job than another. That's not necessarily the case. I think we've learned from some other academic studies. There was one group of academics that basically used a match sample of 75,000 orders, and they sent it into different brokers. And what they found out was that there was somewhat different execution performance. Now, when I looked at that paper critically, my takeaway from that was, yes, there was somewhat different execution performance, but it wasn't because one broker was less sophisticated than the other, but potentially that the composition of the customers was different, and the wholesalers, to the extent that some customers were more attractive to be the counterparties for the wholesalers bid relatively more or less aggressively across the different firms. So what it means, therefore, that one firm has better statistics than another, I think is not what most people necessarily think. But I think nevertheless, providing better data is a good first step. But it's not necessarily the panacea that I think many observers think.
Thank you so much, Professor Spat. So next I want to turn our attention to the proposed reforms of Reg NMS, so thinking about fees, ticks, and odd lots, just very broadly. As was mentioned earlier, Reg NMS was adopted in 2005, and so as many would say, to say it's long overdue for an update would be probably a slight understatement. On December 14th, all 5 commissioners voted to propose significant changes to tick sizes, to lower transaction fee caps, and to promote transparency in some better priced orders. So while the proposal that came out that day of the 4 was the shortest, it may have, some would say, the broadest overall market impact. Notably, the proposal included some of the following changes. First, it proposed to adjust tick sizes to sub-penny increments that would range from 1 penny to as low as 1/10 of a penny. Second, and relatedly, the proposal would level the playing field across market centers by allowing exchanges to quote and trade in sub-penny increments, similar to what ATSs and certain internalizers can do today. Third, the proposal would shrink the fees to 5 cents per 100 shares for stocks trading at the 1/10 of a penny tick, and 10 cents per 100 shares for all other stocks. Fourth, the proposal aims to increase rebate transparency by requiring that fees and rebates be known or determined at the time of execution and not ex post at the end of the month, as is currently done today. And finally, the proposal would accelerate adding odd lot orders to the publicly disseminated consolidated tapes. So this proposed set of rules, the proposed amendments to NMS, is really quite broad in terms of what it covers, right? And so I'm thinking that we're going to probably spend a bit of time talking about this because I know that there are many of you who are interested here. And so my first question is going to be to John and Mitt. You guys can decide who goes first, right? And so an interesting aspect of the proposal is that it requires venues to make the fees and rebates known to brokers at the time of trading as opposed to ex post. How do you expect this to impact trading or impact the ways in which brokers act within the markets, right? So overall, what impact do you expect this to have on the market and why? So.
You want me to go first? Okay, all right. Number one, I think this was one aspect of this proposal that seemed to be very uncontroversial, a lot of support for doing it. And it's mostly around providing a more transparency around the actual economics of trading on exchange. So just so people understand, the way that exchange pricing works on the largest exchanges is the pricing often is not determined at the time that a trade happens, but a broker's economics of sort of like what it's charged for trading in an exchange will be based on sort of so-called tiers, and the tier proposal is a separate proposal, but just stay with me for a moment. You don't know until the end of the month what the actual economics is. And one of the aspects of that is that it's very hard for people to make apples to apples comparisons across exchanges as to what the costs of executing in one place versus another are. So the idea around this proposal is just to say, whatever the economics are around a particular trade, if you want to do it sort of in a tier or other basis, that needs to be done on the basis of previous volume, say last month's volume rather than the current month's volume. So at the time that a trade happens, any particular investor, whether it be a pension fund or an asset manager or anybody else trading on an exchange, can know what the actual economics are related to that particular trade. And then at least for some institutional investors, maybe that would provide them a greater ability if they want to try to negotiate to get a return of those economics to be able to do that. So I think it broadly, more transparency, more investor friendly, a better ability to compare markets against each other.
Mitt?
There's a lot to unpack on this rule. This is probably of the 4 rules, this is probably the most significant, has as much detail as you can imagine, and it's not one rule. We're going to talk about ticks, we're going to talk about fees. This was also thrown into the proposal as well, and I think it requires a little bit of context as to why I think this rule was proposed. So there's generally a perception that there's a conflict of interest between institutions and their brokers when they are routing orders on behalf of us. And the conflict arises when I send my order to a broker. The broker has to go to a specific exchange, whether it's a dark venue or a lit venue. They have to go to a venue to execute the order. Each venue charges something different. Exchanges tend to charge the most, the access fee being 30 cents per 100. Dark venues probably charge least. There's some single dealer platforms that may be free. You get the idea. And the assumption was that we can't necessarily quantify or control that conflict between us and the broker. So if we were to make those fees more transparent, the conflict would kind of be eradicated. I don't think this rule solves anything. I mean, knowing what the fees are before or after the execution does not change at all why a broker routes an order to a particular venue. And by the way, I'll be clear, I do not feel our brokers are routing orders to exchanges or to other venues just because they're trying to get either the highest rebate or they're trying to avoid the largest fee. I think like I said, T. Rowe is sophisticated enough to be able to vet out the idea that if there was a conflict, we'd probably identify it within our order flow because we can compare that routing practice of different brokers and be able to identify if something nefarious was taking place. Further, one of the things I think the SEC was hoping to solve for is if you can push those fees back to an institution. So right now, the brokers incur those fees or potentially earn a rebate for going to a particular venue. The idea is send them back to the institution. Now, they can't do that right now because they are retroactive. And so if you were to send me a check at the end of the month because I generated some rebates, I wouldn't know what to do with it because the amount of clients that we have, the trading that we have, tying that back to each individual order and each individual client to send them the check, because again, I'm not generating any revenue off of trading, would be a significant task for any large institution. So the SEC figures if we can go ahead and make those transparent at the time of execution, then you would know what your fees are. They could actually get passed right back to you in the form of execution price, and either the asset owner would incur that or we would incur that. I think what it does more than anything is just pushes the conflict, if there is a conflict, upstream. So instead of pushing it from the broker and asset manager, you're going asset manager to asset owner. And for folks that may not recognize how our industry works and how complex trading is, I don't route orders based on rebates or fees. I don't instruct my brokers to route orders based on rebates or fees. But my asset owners don't know that. And when I try to educate them on that, sometimes it's just an explicit price that they're seeing. And it's, why not go to a venue where you're getting a better price for me than a venue where you're getting a worse price? And for example, John Ramsey works at an exchange that charges fees on both sides of the transaction. They do not pay well, sorry, I should take that back. They started paying rebates recently, but it's a smaller rebate than some of the other exchanges. If we were to tie that rebate into the price of my execution, John would probably never win on an explicit price. So I would avoid going there so my asset owner would say, I need a better price. Now, implicitly, I might get worse execution overall at the parent level. And I don't want to get into too much in the weeds here, but looking at it explicitly does not necessarily solve for the implicit issue when we try to route things. And that's why I'm not in favor of this at all. I do not want that conflict pushed upstream where we have to explain it. I think we have a very good relationship with our broker-dealers where we recognize that they're not routing conflictedly on our behalf, and we're able to measure that so that if there is anything that looks suspicious, we can obviously address it.
And just very briefly, so that because IAC in our fee structure was mentioned, we are providing for displayed orders a flat 4 mil per share rebate that is flat, so it's deterministic. At the time the trade happens, you know exactly how much you're paying. So we've done this in a way that people can determine and know exactly at the time of the trade. And at the time that we did that, there were an awful lot of people in the industry, brokers, as well as institutional investors who said, we understand why you're doing that, and we're so glad that you're not doing that in a way that is sort of tiered or that is less transparent. And so that's part of the reason why we did it in that way.
Okay. All right. So thank you both for that. And that was really interesting to hear both sides of that debate there. So another interesting part of the proposal that I mentioned earlier is the reduction in tick sizes, right? So going to sub-penny increments. So in agreeing that some stocks are tick constrained, and the SEC used its own methodology, and arguably there are various methodologies one can use to determine a stock being tick constrained or not, but we're just assuming or accepting the SEC's methodology, the SEC identified that a large majority of shares that are being traded right now are what it would define as tick constrained. And so to address this issue, the SEC proposed 4 minimum pricing increments or ticks based on the stock's weighted average quoted spread. So I want to know, Anna and John, and actually, I'll actually take anyone who wants to express any thoughts on the ticks, really, the pricing increments. What are your thoughts on the proposed ticks? Are they too nuanced, not nuanced enough? And what impact do you think they'll have on trading? Anna, I'll start with you, and then I'll see if anyone else wants to chime in.
So I think, I have 3 main answers that I think could be the issue. The first answer to your question about the proposed ticks, of which there are several, one is granular to, down to a tenth of a penny. I think that's probably could be a bit too granular, because depending on how the stock trades, what it could do is, and the behavior, at least from maybe an institution who may want to get more liquidity in the market. If, for example, if they're looking to trade 1,000 shares and that 1,000 shares is, set out across 10 price points, right? They may be unwilling to cross the spread initially, and if they do, to go deeper into the order book to capture those shares, they could be moving price, which might increase volatility, intraday volatility in certain stocks. What that might also do is, as a consequence to that, institutions who typically trade larger quantities of stock, they may be further incentivized to trade more off exchange. They may be willing to be more patient and wait to trade a block, which, might not help the displayed market, because they can actually trade more potentially off exchange if, rather than having to cross the spread, incurring volatility, which could also impact their own execution quality and also that of the broker. So I think that could make things a bit more difficult. And, I think we all agree that, both on and off exchange trading is critical to markets. One of the things that I think about is, back in 2001, when the U.S. Market system went to decimalization, there was a comment letter that the SEC had sent out to the Investment Company Institute to comment on the potential of sub-penny pricing after the move to decimalization. And what the comments came back with was they found less depth of book, and it was more difficult for institutions to trade larger sized orders. And so the fear was, if that continued to be the case, that was going to continue to happen. And so I think, while the market system is very different than what it was in 2001, I think that is a very real concern and potential outcome. The third thing that I also think about with the tick sizes is the frequency at which they would need to be updated, which is not, I believe, is not going to be the same as, say, the new round lot sizes, which is also becoming implemented at the same time, at least within the same proposal. So the new round lot sizes could change the tick size as well, so they're not in sync with one another, and that could have an impact on trading, at least in form of confusion, or if you have the round lot size change and it should actually be trading in this particular tick size bucket, that's where some kind of uneven issues might arise. But again, that's just speculation, but it's one of the 2 things in the in the proposal that might need more clarification.
I really quickly want to just say to a previous point that Mehmet had made that while T. Rowe Price does a fantastic job of routing orders, fee-sensitive order routing is a problem still in markets. So making fees determinable at the time of execution, I think, is an important change. I think most commenters recognize that. To go to tick sizes, I think we need to take a step back and we need to see what problem is the SEC trying to solve, which I think is an excellent question, and I think there are good answers for that in every proposal that we should really focus on. But for this one, what the SEC saw, what the Commission saw, is that there are stocks that are trading that are highly tick constrained, and that the ideal would be that there are a certain number of price increments within the spread. The SEC said 4 to 8 ticks within the spread. Most commenters settled at around 2 to 4 ticks within the spread. And this is really important because it drives, part of it drives how much trading takes place off exchange, because the current regulatory system has many features of it that give an advantage to off exchange trading venues. And this is an example of one of those. And we have seen our markets transformed into a system in which half of trading or more in some stocks, 70 to 80% of trading takes place off exchange, and we have lost the price discovery mechanism, right? And I think that is the theme for a lot of these rule proposals, is how can we get back to markets in which we have an effective price discovery mechanism taking place on lit exchanges, which is what our markets should prioritize, and how can we help US markets get back to the point that they are the best in the world, because they are not. And we can discuss that in a little bit and talk about the statistics as to why they are not. But this is one of those rule proposals that will help to do that. And what it will do is it will both modernize our quoting and trading system in terms of those increments. I think the proposal is a bit extreme. I don't agree with 1/10 of a penny quoting increments, 2/10 of a penny. Those are too small. But almost every comment letter said 1/2 a penny. That makes a lot of sense. And most importantly, we need to harmonize trading increments between on-exchange and off-exchange trading venues. That is a far more important change that this rule will bring than the idea that we can have, so many different pricing points within a penny. And that is how you start to change the dynamic of off-exchange trading systems having a regulatory advantage over our lit markets. The last thing I would like to say is that when you think about how many ticks should we have within the spread, this is something that goes across the entire market. And so we have a lot of stocks that trade at very wide spreads, and they have a huge number of ticks within the spread because they are not tick constrained and they are lower liquidity names. And so unfortunately, I think the SEC missed an excellent opportunity with this rule proposal from a tick and quoting perspective, because years ago, a lot of smart, very experienced people got in a room and came up with what was called the NASDAQ Intelligent Tick Size Proposal. And that said, yes, we should go down to 1/2 a penny for tick-constrained names, but also we need to widen the quoting and trading increment on the other side. If we're trying to figure out how to get away from a one-size-fits-all market structure into one that accommodates lower liquidity, smaller companies, one that can provide a vibrant capital market for small and mid-cap names, that's how you do it. And I think it would be extremely important in considering recommendations to the Commission that you consider adopting that as one of them, because that would really transform market structure and would really help with an area that almost everyone agrees is a major problem in these low liquidity names, but there's very little here that can help with them.
And I would just say on the tick size, just so people, those of us who have been living this, all that you can get down into the weeds very quickly. The 1 cent standard that the SEC established back in 2005, I think there is very wide agreement, has become outdated. The markets have changed in huge ways over that time period, and no question that there are an awful lot of stocks where clearly the market wants to trade at finer increments. The Commission's proposal was, in the view of most people, I think, a lot of people maybe overly aggressive, as Dave suggested, in paring the tick size all the way down to 1/10 of a cent for some stocks. People thought that it was too many different price points and too narrow. And so I think the question, sort of getting back to basics, is what is the change that best serves investors? What are the price levels at which investors want to trade? And I think that there is a lot of indication and evidence that investors would like for an awful lot of stocks to be able to trade at that 1/2 cent increment. when you start going down to a tenth of a cent, I don't believe that there is much interest on the part of investors in trading in increments that are that fine. And so then the concern is that you're not benefiting investors. Who are you benefiting? Potentially only sort of the best sort of speed-enabled firms that can kind of negotiate all of that additional complexity. So I think, again, as with so many topics, the question should sort of get back to how do we best serve investors and what it is they're most interested in doing. If we serve investors well, then everything else will work out fine.
So I got to start by agreeing and disagreeing with a few things that Dave said. One, I would say, although it's not perfect, the U.S. equity markets are the envy of the world. We trade more notionally on an equity basis, and 99.9% of the time we do it fairly well. But we are the envy of the world when it comes to trading. And believe me, I have a global remit, so I know what the rest of the markets across the globe look like. And like I said, we're not perfect, and there's definitely areas of improvement, but there are far worse places to trade than in the United States. Second, I don't want everyone to assume that dark trading is bad trading. So a lot of times you hear when you're not on an exchange or on a lit venue, you're trading dark, and that's a bad thing. That's not a bad thing. Dark venues exist because certain industry participants find better execution quality on those venues, institutions being one of them, because we can place much larger orders on those venues and still remain, so to speak, hidden from the market, where we're trying to find a very large contra and trade 100,000 shares versus trading 100 little shares. If I were to put 100,000 shares displayed on an exchange, I can tell you right now I'm going to have impact on the security. And so we use those dark venues because we need to. They're not nefarious in any way. I know it sounds dark, so everyone says like, oh, there's some bad behavior going on in there. They are regulated, just like the exchanges are. And when it comes to the point on price discovery, it's obviously we need price discovery. And quotes are important, but so are trades. And I think people forget that point. Every trade that takes place in the United States goes to the tape. So whether you trade on a dark venue or you trade on a lit venue, that goes to the tape and gets reported, that everybody can see. Those trades drive price discovery just as well, if not better, than quotes. When someone is quoting 100 shares aside on a security, yes, that's price discovery, and I appreciate that. When someone trades 100,000 shares at a price, that's price discovery. And everybody gets to see that. So that being the context there, let's go to ticks. When it comes to tick sizes, again, too granular of a size is difficult for institutions to trade. And here's why. We're looking for size when we go to lit markets, right? I trade orders that are on average about 20% of the average daily volume of a security. So pretty significant. I'm looking for as much liquidity as I can have. When you're tick constrained, that means that you can't narrow that price anymore. A lot of queuing occurs at those price points, which is actually pretty good for an institution because for a penny, I can go ahead and get a large quantity of volume, whether it's offered or bid. If you narrow the tick, you're going to narrow people posting at different price intervals. When you do that, there's going to be less size displayed. We saw that. Anna referenced ICI's comment letter back in 2001 when decimalization occurred. We saw a 67% decline in displayed size when decimalization was put in. If we go to a tenth, I'm not saying it's going to be 67%, but it's going to be pretty significant decline in displayed liquidity at those price points. And if, I don't want to get too into the weeds here, but order protection is a very important thing in the United States. That's the crux of why Reg NMS even exists. There's a rule called 611, which is reason why Reg NMS was kind of instituted in the first place. That rule only protects the top of book, meaning that first price point. So right now, if I were to take a stock, XYZ, and it has a penny spread, and we'll call it tick constraint because there's a lot of volume queuing up, both on the bid and the offer at a penny, and we narrow that down to a tenth of a penny, I'm not protected at a penny anymore, meaning you're going to have a lot of behavior of people posting within 10 different increments and fading, flickering, whatever they're doing to find the right price. And it's not nefarious. I don't want it to make it sound like market makers are doing anything that we don't want them to do. They're dynamically making a market. So as they see information, they'll post a quote, and then they'll retract that quote and reprice it somewhere else. And so that becomes very difficult then for an institution to try and get that liquidity, where I have to sweep a book and chase a bunch of very sophisticated folks that are using laser beams, as you said, to trade, when I don't have that type of technology. So from our perspective, too narrow is not good for institutions. When it comes to half a penny, I got the opportunity to be on that NASDAQ Intelligent Working Group back in the day, and we did get to the conclusion that there are stocks that are tick constrained, but we have to find the right stocks that are actually tick constrained. So when you look at the SEC's proposal, they have 4 tiers. One of those tiers actually says that if stocks on average, if their weighted average spread is up to 4 cents, they should narrow that increment to half a penny. So the market is telling you that on average, a particular stock trades up to 4 cents wide all day long. And by the way, it trades wider in the morning and it's tighter in the afternoon. And so the fact that it's 4 cents on average tells you it's pretty widespread. Why would we narrow the increment on that? That makes no sense. The market is telling you it's not tick constrained. If it were, it would have a penny wide spread, because that's the constraint. So if you were to look at it and say, I'm only going to change penny spread stocks, or on average 1.1, 1.2 cents, whatever it might be, that have large queues, because again, that means that there's competition to narrow that spread, right? There are multiple people bidding and offering to try and narrow that price point, but they can't do it right now. But if you have large queues and a very narrow spread, all in favor of taking that tick increment down. To what Dave said, and one area I will agree with him for sure, is wider ticks are also great to have for large institutions for the same reason. When you narrow the tick, you lose size. When you widen the increment, you gain size at those price points. So again, I don't want to artificially do it. There was a tick pilot study that was done a few years ago, terrible outcomes, because they took stocks that had 3 cent wide spreads and pushed them artificially out to a nickel. That's bad. What I'm proposing is if a stock has a $2, for example, spread on average, it shouldn't trade at a penny increment. It should trade at 25-cent increments, because then people will pool liquidity at 25 cents. And when you try to jump someone, the incentive to jump them will cost you 25 cents. Versus now, where there's no incentive, it is a penny. And if you go to a tenth, by the way, what do you do to the incentive to post? Someone can jump ahead of you for a tenth of a penny. Are we discouraging people from posting lit liquidity?
All right. Thank you, Matt. Professor Spott, I know you wanted to jump in.
Yeah, I wanted to weigh in on a few points related to the broader discussion. On access fees, the Commission's proposal is to potentially bring down the access fees from 30 mils.
Okay, give me a minute. That's going to be one of the questions that I wanted to do. So
Let me address some other points. So on the issue of dark versus lit, I think one of the pieces of evidence that's pretty interesting is that the firms that are not accepting payment for order flow are routing in similar ways to the firms that do accept payment for order flow, which relates to the issue of whether it's incentive conflict or not. And I think really at the core of that is that the off exchange, I agree with Mehmet on this, that the off exchange is not necessarily nefarious. Off exchange, part of the advantage that off exchange has from the retail perspective is they want to bid aggressively for retail because they view it as uninformed. But that actually is that's sort of the natural opportunity and advantage to retail. And on the issue of odd lots, by coincidence, yesterday I got a query from an academic, actually not working, a distinguished finance professor not working in the market structure domain, who asked me about a fill that he got and whether he should be complaining to the commission. And what was the nature of the fill? He had an order for a few shares, and there were executions that happened at inferior prices, and his order didn't execute, and he kind of thought, should he be complaining to the commission about this? And I think the answer is, well, the problem is that his odd lots are not protected, and he was traded through. So that seems to me it seems to me kind of an issue about the nature of odd lots and the nature of the regulatory regime, and what we want to do about it. But I don't know. I mean, it may be that's associated with the infrastructure reforms. I'm not quite sure. But I think this issue of the treatment of odd lots is an important one in a world in which trade sizes have become smaller and smaller, and it's also related to price levels becoming larger and larger.
So piggybacking on Professor Spat's point there on shrinking tick sizes and then access fees, right? So in addition to shrinking these tick sizes, the proposal also shrinks fees to 5 cents per 100 shares for stocks that are trading at 1/10 of a penny, which we've kind of talked about not being so great, but also 10 cents per 100 share for all others, right? So Met mentioned the transaction fee pilot that was vacated. It had its own set of it had its own fees structure that it proposed, which was 2 cents. So here, we had the fee structure there for the transaction fee pilot was 2 cents. Now we're proposing 10 cents. I'm going to use the 10 cents one instead of the 1/10 of a penny, right, for our discussion. So we had 2 cents on one hand. Now we have a proposal for 10 cents. What? I don't want to. It's not law. It's vibes, but. What feels right, right? So how do we think about these different access fees? Are we closer to getting it right, John? Are we still far away? Are these fees still too high? Or is that not the right question?
Yeah. Certainly some of the right questions. And so I think with respect to access fees, I think it's important to go back to basics, again, to the purpose for which, why we have an access fee cap to begin with. So when the SEC created this structure they called Regulation NMS, they said exchanges are going to have the benefit of so-called protected quotes, meaning you can't bypass them for a worse price. But because that gives exchanges much more leverage than they would otherwise have, that they can't charge whatever they want in order to access those quotes. So we're going to cap it at 30 cents for 100 shares, 30 mils, to use the nerdy term. So the question is, I think that there is very wide consensus in favor of shrinking that cap. And again, the question is, what is the impact on investors? So when investors trade on exchange disproportionately, they trade to access fees, access quotes, rather than post. So in essence, the existing 30 mil cap acts as a sort of hidden tax on investors' ability to access liquidity on exchanges. There is plenty of data, and IAC has provided a lot of that for the record, that other kind of market-based factors around costs have shrunk substantially. But because the rule pegs the access fee you can charge at 30 mils, that's overwhelmingly what people charge. So there is also a very large body of institutional investor comment favoring a uniform reduction in access fees to the 10 mil cap level. Again, to kind of align with market-based factors in terms of collapse in commissions and spreads and other factors. And another point that's interesting to think about is Dave mentioned the minimum trading increment. So part of what's being considered here is to set a minimum trading increment of 1/10 of a cent, which is, interestingly, an idea that was endorsed, at least at one point, by New York Stock Exchange, Charles Schwab, and Citadel Securities, right? So a lot of different people saying that's true. So in trying to figure out where should you set the cap, it's important to think of that minimum trade increment. One of the reasons why we think 10 mils makes a fair amount of sense is why should you allow, and if otherwise, at the existing cap level, you would say an exchange can charge 3 times in order to access its quote the amount of the minimum trading increment. So if you're trying to compare executions across different venues, that inflated access fee, I would say, distorts the exchange pricing and quotes. Exchange quotes become less useful as a way of determining what the best price is, because the price that's shown is not the price that you're getting. There is this hidden fee that is factored into it. So that's why I think there is overwhelming investor support for reducing the fee cap, and most of that comment would favor reducing it to 10 mils.
Anna?
Thank you. So I think what's very important to remember between, to John's point, when the access fee was initially set out, including tick sizes, so my answer does go back to the previous question a little bit, is that the entire Reg NMS system is designed to ignore stock price. It's intentionally designed to ignore it. And so tick sizes and access fees have become much more related. And you may hear the expression access fees as a percentage of the tick size. That is, it is a very relevant piece today. But when Reg NMS was first implemented, it was not. And so the access fee was simply a measure of what trading venues were charging at the time. So, but the bottom line is what the optimal tick size or access fee might be. Regardless of who it is, it's only going to be an estimate. I think we have no data in terms of what optimal or what sub-trading and quoting looks like in this framework today. We just don't have that. And so, and I think, from John's point, I think, there was a good percentage of the industry that was willing to rally around certain stocks, at least some consensus around half a penny in certain cases in certain stocks, and maybe, with a lower access fee, right? There were differing opinions, obviously, and a lot of well-reasoned analysis and comments around that fact. But because of this other data, or because of the data that we don't have, I think what Commissioner Ueda said yesterday was we don't have the time machine, we don't have the flux capacitor, to look forward in the future. But I think there is a way that the Commission could possibly do that, which we had written in our own comment letter, which was to use their exemptive authority that exists under Reg NMS today. Under Rule 612, which is, the tick size, the Commission does have the authority, with conditions, so bear with me for a moment, to lower tick sizes today. They can make it conditional. They can make it, conditioned upon everyone has to do it, however they lay it out. So in our comment letter, we used that as potentially a way to say, use this industry consensus, and you can actually change tick sizes for a very small subset of stocks where the industry did agree, perhaps half a penny, lower the access fee. Maybe, people want it lower, they want it higher, but some way to actually get sub-quoting and trading data in our current framework, practical data that the entire industry can analyze without having to rely on estimates or data that we simply just don't have because it's unable to be released to us in the consolidated audit trail. I think, but the most important thing to that approach potentially is not just practical data, but because, and I will say, and I should say this too, this was requested by one of the exchanges in 2021. And that was really the spark that had got us thinking about it when we wrote our own comment letter, is it kind of was before all of these conversations and proposals had started to happen. So I felt that maybe it was kind of lost in the shuffle a little bit. But I was like, wow, that's actually a really interesting way to potentially do it in real life. And so, but most importantly, what that does is exemptive reliefs could serve also as a rollback plan through an expiration date to say, here's how we're doing it. We're going to do it for these stocks. We're going to expire here so that if you actually, find something materially wrong or, a consequence that the commission participants were unable to foresee, well, with that expiration, we can actually go back and prevent those unintended consequences because we have that practical data.
So I'd like to say something a little controversial here.
Could you be really quick with that, because we do need to keep moving?
Yeah.
Thank you.
That is to get rid of the access fee cap. It's government price control. It's a huge problem, and it does not serve a purpose except because we have rebates. That is the only reason we need an access fee cap. And if we could get rid of rebates and payment for order flow, we can have a much simpler market structure. We don't need an access fee cap. We don't need these distortions to order routing behavior. The SEC found that access fees and their associated rebates tend to increase transaction costs for demanders of liquidity and exacerbate a problem of liquidity oversupply for stocks with narrow spreads while doing very little to enhance liquidity in stocks with wide spreads. And the reason that bringing the access fee cap down in isolation is relatively problematic is yet again where we are handcuffing the on-exchange space in favor of the off-exchange space, who will have no similar limitation as to the size of rebates or payment for order flow that they can pay, and it could exacerbate the problem of off-exchange trading, which is absolutely not, generally speaking, a bad thing when it involves block trading by institutions, but it does harm market quality dramatically when it's small retail orders who want to take liquidity. And so this is the simplest approach, which is to get rid of payment for order flow and rebates. And I really just need to give one quote from Ken Griffin, where he said payment for order flow is such a conflict of interest that it cannot be cured by disclosure in 2004. And he said internalization is the greatest threat to price discovery in financial markets. And I just need to say that I completely agree with Ken Griffin.
So the only thing I want to just interject real quick is you do need a fee on access, a cap on access fees because of the order protection rule. So we have to route to an exchange that has the best price. If there's no cap on the fee to interact with that quote, an exchange can charge us anything they want and say, I have the best quote. If you have to come get it, you are required by regulation to come to me. I can charge you whatever I want. That's why a cap has to exist. Now, Dave's trying to make the point that if you got rid of rebates, fees wouldn't go up astronomically. But regardless, unless we get rid of the trade-through rule, which is 611, we cannot take away the cap on access fees, which is 610.
Just another opportunity to simplify markets.
No. I'm taking back control of my panel. Thank you so much. This has been great. I am back. Okay. This has really been great. This is why I wanted to do this in person, because I can't control you guys now. Okay, we don't have a lot of time, and I do want to talk about the auction proposal, right? So that might not get your gears turning as much, but it gets my nerdy brain turning a little bit more, right? So, and it actually goes, I think, great to where we left off with payment for order flow, right? So one of the things that the SEC proposed in its package of equity market structure reform is this order competition rule. And so under proposed Rule 615, we would have order-by-order competition requirement for certain retail orders, and there are limitations there and scopes there as to how that would work. And so notably, what I want us to just pick out here is that Rule 615 would prohibit a restricted competition trading center from executing a segmented order until after the broker-dealer has exposed this order for competition. So in almost like an auction style, trade before they can internalize it or execute it on their own. And so one of the things that we see here is that this order-by-order competition proposal is in some ways a response to some of the concerns that have been raised for payment for order flow, right, in the way in which our current market is structured. And so I want to start with you, Professor Spat, if I may. Do you think that this proposal to display retail orders one at a time is logistically feasible, right? And how do you think this is going to work in the marketplace? And I guess and you can kind of fold this all into one answer, right? Does this really address the problem for payment for order flow, if indeed you think there is a problem?
Okay, so there's a lot in that.
Yeah, there's a lot in
Let me
there.
try to unpack it as best as I can. So is there a problem with payment for order flow? Well, first on that, I'm not so sure.
Okay.
I think it's more likely that there's a problem with payment for order flow in the options market than there is in the equity market. But I also think it's important to keep in mind that payment for order flow is one dimension. Zero commissions and the relationship between commissions and payment for order flow is another dimension that's kind of lost in the debate. I think the empirical evidence that the order routing is very similar by firms that don't take payment for order flow and firms that do take payment for order flow is also suggestive that maybe there isn't a problem. That's on sort of the payment for order flow aspects. On the issue of order by order auctions. So my collaborators and I, we've written a paper about this notion. And part of the point that we really highlight is the distinction between ex ante and ex post competition. That's really kind of fundamental to our analysis. The current way in which competition works among the brokers as they engage with the wholesalers is really one of ex ante competition. The brokers basically look at the history that they got from the wholesalers and then route consistent with that. The wholesalers who have given them better performance in the past, they send more of their business to, and the wholesalers know that. The brokers hold the feet to the fire. The data that we got from various brokers confirms that they reroute in that fashion. Now, is ex ante, now conceptually, is ex ante and ex post, I think that ex ante and ex post competition, first of all, I think ex post competition isn't necessarily superior to ex ante. Ex ante competition is very good, and a lot of our mechanisms in society are set up on the basis of ex ante rather than ex post competition. I think in this context, the Commission is hoping that institutions are going to kind of enter and provide ex post competition. When I say institutions, I mean other than the current wholesalers. So, for example, your favorite hedge fund or BlackRock or others would enter, but those institutions basically tend to have one-sided positions. They're mostly either interested at a point in time in buying or selling, and so as a result, if anything, that's going to cause the traditional market makers to pull back, and I think that's going to be, in fact, disruptive to the mechanism. What our theoretical paper highlights is that there really is a tension between the nature of competition and this sort of greater adverse selection that potentially would result. Now, your question also, and so in effect, our paper, I think, is an argument against this, and I would point to a couple of other conceptual points. When I've talked to other academics, they say that the goal of what the regulatory environment ought to be providing is similar experience for different orders, for different retail orders, and that an order-by-order system would seem to kind of run against that. That perhaps what the regulatory environment ought to provide is to facilitate more batching of auctions rather than separating the auctions. I think that's a well taken. I think that's a well taken point. And finally, I should note we currently have a system that's a little bit like auctions. It's called the where retail gets special treatment. It's called the retail liquidity programs, but by and large, there hasn't been much uptake on those, and I think that's also a very relevant point, and we've tried to highlight that in some of our work. Your question also raised the practical issue: will this work? What will happen? I think where things are most likely to break down would be for less liquid securities and in stressful and volatile times. I think it's not so clear whether there are going to be counterparties, so to speak, or in fact to be counterparties with much wider spreads. One of the things that's interesting about the current arrangement is the brokers basically tell the wholesalers, you will take all of our orders and you will execute at the MBBO or better, and then we'll evaluate you over time. But the wholesalers basically don't have the option not to participate. If we move to this type of system, presumably the wholesalers are going to back away for the less liquid stocks and/or in the more stressful times. And I think that's one of the challenges with respect to how the proposal would actually work.
Anna, did you want to give some comments?
Sure, I did. And I'll make them quick. So there are two comments, and my comments about the OCR, as well intended as it is, I think we all agree competition is a very good thing, right? It's at the core of our markets. But two things. One, in a way, the U.S. has already done this before, and there's an old rule, it's called New York Stock Exchange Rule 390. And it was in place well before Reg NMS. It was actually called the Market Responsibility Rule. And what it did was it prohibited members and member organizations from affecting any transaction, whether in any listed stock, over the counter, in principal, or in agency. And so it had to go, and the purpose was to increase the interaction between retail investors, all orders, on a designated regulatory mandated exchange, right? That's how it worked. In 2000, when the New York Stock Exchange actually rescinded that rule, and historically, from at least the literature says, the old rulemaking, the SEC really wasn't a fan of that rule. And the reason they weren't was because what it did was it prevented the broader competition. So they said, well, we understand as much of a benefit as this rule served individual investors, it can no longer be justified at the expense of limiting the competition between other brokers and other trading venues. And in many ways, I think one could argue that this rule is also well-intentioned, but, could be viewed as similar because of the restricted number of venues that will qualify to operate a qualified auction. So I think, there's, that's probably the bigger piece of it. I think the other part when it comes to competition is there are few trading venues that would operate it. One, exchanges, and two, probably an ATS, right, a dark pool. ATSs would effectively have to operate like an exchange, but when you think about the good things that can come of it, we also know we also know things can go wrong too. So glitches can and do happen, and so if there is a glitch on one of these auctions for any one of a number of reasons, right, it can happen anywhere in the market for anyone. The exchange's SRO structure and limited liability could be difficult to find, for an individual investor to perhaps, be made whole if that were what should be the case. Whereas an ATS, a broker-dealer who's operating an ATS would not have limited liability. They would be, they have a lot of liability. Actually, all participants do in some ways. And that's not to say the exchanges wouldn't want to make their parties whole at all, because they do and they have. But that structure does make it a little bit more difficult, which could increase or diminish the competitive forces.
Okay, so in the interest of the time that I know we do not have, I'm going to do this a little differently. So, Met, I'm going to time you. You get 2 minutes, Met. Dave, you get 2 minutes, Dave. You do not get to interject. You get 2 minutes. And John, you also will get 2 minutes. You've been well behaved, so I could even give you 3.
I appreciate that.
So I'm going to have you guys use your 2 minutes, but then I'm going to open it up to my colleagues to see if you guys have any questions to wrap us up, and that's how we're going to finish out this panel. Okay, so Met, Dave, John. Thank you.
All right, good thing I can talk really fast. So when it comes to the order, the OCR, it's really about 3 O's that kind of matter here. One, we're doing this one-size-fits-all approach, and Chester laid it out really well, so I'll just summarize. There are securities where it would make sense for an institution like T. Rowe to participate in those auctions. Very liquid names. We all want to get in there. We want as much liquidity as possible. And it's going to be easy for us to have the other side of Apple, Microsoft, Amazon, whatever it might be. Where obligations and optionality come in is, as he said, wholesalers do not have the optionality to choose and pick which securities they do and don't provide prices for. We do as institutions. What you don't want is an OCR where retail is coming through as a held order, by the way, telling everyone, I need to do this. Not held order like we trade, where we have discretion to pull back from the market. They are coming in, they're vocalizing that they want to do something that's disseminated to the marketplace, and no one is obligated to be there, right? Because I can choose my optionality to not interact with them when it's not beneficial to me. Who's going to provide the other side of that liquidity? And even if I wanted to be there, Chester's right, I am usually, if I'm buying a security, I'm buying a security. If I'm selling a security, I'm selling a security. I am not making two-sided markets on 8,000 tickers. The one-size-fits-all approach, though, is not just in auctions. It shouldn't be applied to access fees. I am not supportive of a 10-fee access fee across the board. And the reason is, I don't know how that's going to impact the liquidity of those stocks. And so if you do these experiments, do them with one factor at a time. If you want to narrow the tick for a security, then go ahead and take the access fee down commensurately to that. We can measure whether or not liquidity is impacted, and then if we need to further refine it, we can do that. Taking an across-the-board approach on every ticker that exists in Reg NMS, bad idea. Thank you.
Thank you. I'll make this quick, as quick as I can. The OCR is setting out to solve a problem, which is too much off-exchange trading, and that off-exchange trading is not competitive. It actually fits the Department of Justice's definition of a highly concentrated market. That is a huge problem. And we have robust competitive markets, and we have firms that want to compete for these orders on exchange. And when we talk about the order competition rule, we tend to highly focus on execution quality when we should be talking about market quality. And U.S. markets have deteriorated from a market quality perspective because of this level of internalization and off-exchange trading. And this was shown in the tick size pilot when they tested a trade-at rule. And they found that with the trade-at rule, there was a 30% reduction in quoted spreads. That is a multi-billion-dollar a year cost that is flowing from investors to high-speed speculators and internalizers. That is the problem we need to address, and a trade-at rule would solve it. The order competition rule is close to a trade-at rule, except for this prescriptive auction element. I think that that prescriptive auction element is not needed, it's not necessary, and a trade-at rule is far simpler. It says you cannot execute off-exchange unless you provide material price improvement, or as the OCR would say, unless you execute at the midpoint, and the midpoints will change as ticks compress as well. Other countries do this. Australia and Canada. In the US, we saw huge improvements in market quality when we tested the trade-at rule. It's not some speculative thing. There is excellent research that shows that this is an important thing to do, and that competition on exchange is 2.3 times more competitive today than off exchange. The SEC in the OCR proposal showed that this cross-subsidization on lower liquid names is not actually happening. And that's a myth. And what we need to say is execution should be on exchange where it can be competitive. And if you want to execute off exchange, you have to do that at the midpoint.
Thank you, Dave.
I'll be very brief, and I won't talk about OCR, but I will mention the premise or the concern that reduction in access fees to 10 mils, say, will disrupt liquidity in a way we need to be worried about. I realize some firms have made. Institutional investors, including some of the most sophisticated ones in the world, I'm talking about Vanguard and Capital Group and Invesco and Brandus and CalSTRS and CalPERS and on down the list, have all said that they are not concerned about that and that they believe that access fee, they certainly understand the arguments, but they have not accepted that premise. That's all I'll say about that.
Thank you so much. Are there any questions from the panel, from my committee members on any of the topics that we've discussed, not just the, I knew we would get a little bit more spicy as the day went on, but are there any questions from any of my panelists, my colleagues? Ted.
Yes, I had one question. Matt, now, you talk about all these things that you're not concerned about, but how do you validate conflict if you were to have a conflict?
Yeah, so we do have concerns that there are conflicts that exist.
Mm-hmm.
We measure those. Fortunately, I work at a large firm with a lot of resources, so I have the benefit of having a lot of data, and we can look at that data and determine if there is conflicts in routing. Now, I'm happy that John put everyone else on display for how they view, because if things go badly, we can look back and say those are the firms that agreed that this was a good approach.
Mm-hmm.
I don't know what I don't know.
Mm-hmm.
And so I would like to take an incremental approach when it comes to experimenting. By the way, I'm not opposed to access fees coming down.
Mm-hmm.
If there is a conflict with access fees, I've had over 100 meetings in the last 12 years with the Hill, the SEC, and whoever wanted to listen about reducing access fees, but doing it in an intelligent way.
Mm-hmm.
So we measure everything. We identify areas where conflicts could exist, and then we try to verify with data whether or not that is an actual conflict or if it's just the way that the market's operating.
Mm-hmm. Is that internal data that you're acquiring or external?
So it's our trade flow most of the time, but we can also look at broader data sets that include all activity. Chester highlighted when individuals, retail folks traded, there wasn't much of a difference between those that receive payment for order flow versus those that don't receive payment for order flow. And for everyone to understand here, payment for order flow, I know that you attack wholesalers like Virtu and Citadel, that's an expense for them.
Mm-hmm.
That's not money that they are generating. That's an expense they pay to receive those trades. But the same firms that don't receive payment for order flow, like a Fidelity or somebody else, might forward those orders still to Virtu and to Citadel because they're still getting really good execution quality when they do that. So we look at those broader data sets as a marketplace to say, is there a conflict there? So I would agree with Chester. I don't know that payment for order flow is as big a conflict as some others make it out to be.
Okay, thanks very much.
Thank you. Online, I know we have David. You have a question?
Yes, I thank you for everyone in their comments. I just have a couple things, and I like to keep retail investors sort of at the forefront of everything I think of. With that being said, there was a comment made that some of the rule changes, basically the 605, let's say, that retail investors won't really notice the difference. But I mean, you can go back on Reddit and look back 5 to 6, 7 years, then you see retail investors doing deep dives. But with that being said, if the goal of the SEC and a goal of sort of overall is to protect retail investors, why would majority of the sort of exchanges or the trades be happening off exchange? Like, what is the purpose of that?
So I think that's a great question. There are a couple of reasons. The first and foremost is payment for order flow. These off-exchange venues pay to get that order flow. In doing that, as I said before, what happens when you divert all of that order flow off exchange is that the only orders that get to the exchange are the ones no one wants to trade against. And that creates toxicity. That's what the term is. It creates a very toxic environment on exchange in which spreads are wider and everything is more fragile. And so when we talk about how some firms don't accept payment for order flow and still route to the internalizers, this is really one of the core reasons why they do that, because exchange execution quality has become so problematic. There are other reasons, though, as well, which have been mentioned. Exchanges, as self-regulatory organizations, are held up and they enjoy certain advantages, like qualified immunity. This is another fundamental problem in markets. And so I think when you look at how to fix some of these problems, it is very hard to say fix this in isolation. So we talk about an incremental approach, but that's a very difficult thing to achieve because everything is sort of interwoven together. So if you addressed exchange immunity as well as payment for order flow, you could drive many more orders onto exchange, and then you wouldn't even need price improvement because spreads would compress to such a degree, which is exactly what we saw when the trade-out rule was tested in the tick size pilot.
Anna?
Sure. So one of the things I also think is important to notice is that the definition of payment for order flow is broad. It does not just include the behavior of routing to a wholesaler. But in that context, for the purposes of retail investors, there are plenty that do not have payment for order flow arrangements as well. And so where I don't find the data is just because you have a payment for order flow arrangement, just because you don't have a payment for order flow arrangement doesn't mean that other conflicts couldn't come into play and that bad routing, can happen. It doesn't mean that that's not the line. There's a combination of things that affect routing through retail. I think some of that is solved by best execution. Do I think that there could be conflicts? Of course, right there. That's something we should be looking at regularly, no matter what aspect of the market it is. But I think the immediacy, the ability for investors to get very quick executions, and there has been some robust data out there that has shown beyond the current disclosures that retail investors are benefiting greatly. However, I also think that maybe that will uncover some additional data down the road. But in the meantime, the order competition rule also noted in some of their economic analysis that approximately 48% of the orders that were analyzed directly coming from retail investors to wholesalers were being executed at the midpoint. And so that, I think, is a very important thing to consider as well.
Thank you, Anna. Paul?
Yeah, my question is, what posture should the commission take now that it's adopted 605? Should they step back and study the information and data that comes in from that, or should they move forward with the best execution rule, order competition? I think there's some differences of opinion on whether or not the commission should stand down, study, or move forward. I'd just like to get some sense of where you guys come out on that issue.
I'll go first, and then John can take the other side of what I'm about to say. But I would say that I'm all in favor of not stalling progress. So 605 has been approved. That's great. What I guess I'm trying to answer is, what are we solving for? If we're solving for the fact that retail investors are not getting a good outcome, potentially, I think then it's important to move slowly with the other initiatives, because we now finally have our measuring stick, right? 605 enhancements will help us be able to identify if there are problems and whether or not retail is getting the best outcomes. Tinkering with the access fee or tick sizes, I'm happy to do, but we can't do it with the intent of saying that's for retail. If you want to do that because holistically as a marketplace, there are efficiencies to be gained by narrowing the tick and by reducing the access fee, I'm all for it. We don't need 605 to measure that. But we can't say that we're doing all of these things, the best X rule, the OCR, the NMS changes, because we're trying to help those retail participants, and yet we don't have the measurement to determine whether or not they're actually getting a good or bad outcome.
And I won't disagree all that much with what Matt said. Paul, in response to your question, I think you need to look at each of the proposals separately. I would just address, again, the updates to Reg NMS, which are the pieces that we've focused most of our attention on. And I think we believe that, and I think most people in the market probably share this sense that the data that one needs in order to make that decision is data that is available. The 605, until very recently, to my knowledge, nobody ever sort of said that 605 data is like the gold standard that needs to drive sort of the decisions about these things. We have a wealth of different information sources that are available. So I think on those kinds of like what we think of as common sense updates to Reg NMS, the rules that were put in place when a lot of trading was still floor-based and NASDAQ was not even sort of a registered exchange, those should be able to go forward.
Brian Helmer, I'll give you the last question. Sorry, Jamila.
I was intrigued by, Mehmet, your comment that you believed that the routing that you were seeing didn't create any conflicts, there was no problem with it. I wonder if you believe that that's partly or maybe mostly a function of the fact that as a well-resourced, large, sophisticated investor, all of your broker partners know that you have the tools to monitor them, and that wouldn't be a good expectation for other smaller firms or even individual investors.
No, I think that's a fair point. So the one thing that we've argued with around, and like I said, I've had 10 years worth of meetings around the access fee, is the biggest conflict, in my opinion, is not the rebate. It is very easy to identify whether or not your broker is receiving a rebate, and doing so at a much greater rate than all of your other brokers. That comes back in fixed tags. That technology exists. By the way, I was on this fight in 2012 where we didn't have robust data and we couldn't measure things. At this point, anybody in the market, any institutional trader can see what rebates and fees that their broker is incurring. You can measure that. In fact, 606 reports that were provided and enhanced for institutional activity provides that as well. The conflict is the avoidance of the fee. So not going to the exchange because you don't want to pay 30. That's the highest fee you're going to incur throughout any execution you're going to have. But it's very difficult to measure the avoidance of something. I can measure, like I said, someone collecting or earning rebates. I can't measure why they chose to go to venue A over venue C, because venue C is much more expensive than venue A. That's a negative type of measurement. And so that still exists. Now, I can look and say, is the execution generally around the market share of those firms where they should be? So, we trade a lot on IEX. IEX's market share is, around 2-3% of the overall equity markets. If I was not getting that 2 to 3%, for example, then I'd have to question it. If the fact that I'm getting 10-12% of my executions done somewhere, I know there's no conflict there. If someone was preferencing a venue that was very high or not going to a venue with a very high fee, I could question that. And so I think there's more data now that exists even for smaller institutions without the resources, to be able to measure whether or not that conflict still takes place.
All right, this has been great. Thank you to Met, Anna, Professor Spat, John, and Dave. I really appreciate you guys coming and speaking with us this morning. The conversation was lively, to say the least. And I do believe that some of my colleagues might have questions, and if you guys are okay with it, I will forward you those questions and ask for you maybe to just send us some comments, and so that would help us as we think a bit more. Sadly, we did not get to Reg Best X, but you know, there are so many thoughts there. But thank you again, and I'll turn it over to Christopher.
I was just, I'll recap, I was thanking the panelists for their effort. That concludes the morning session. The IAC is going to break now for an executive session, and this public meeting will reconvene at the same address at 1:30 p.m. Eastern.